As we reflect on FX markets into May, it's been clear that there has been a tendency for participants to be wanting to lean towards the flight to safety currencies with so much unknown surrounding the outlook for the global economy as we try to push past the coronavirus pandemic. Since the start of the second quarter, only the yen has managed to outpace the US dollar, while the Swiss franc and euro are moderately weaker. Commodity currencies and emerging market FX have taken much bigger hits, while even the pound has suffered given the still many unknowns around the future of an already fragile UK economy trying to figure out Brexit. The month of April was a brutal one for the global economy, with the fallout from the coronavirus showing the crippling effect on economic activity. Over 20 million private sector jobs were lost in the US, while the unemployment rate ballooned back towards 15%. And yet, through all of this, the equity market took disaster in stride once again, rebounding sharply out from the March low as the whatever it takes mantra ramped up from central banks and governments. The Fed committed to unlimited QE, and the US government continued to pump stimulus into the economy. This was the pattern at major central banks and governments around the globe, and with these efforts came another wave of demand for risk assets despite the intense risk-off backdrop. The S&P 500 has recovered over 30% of the fallout from March. Other notable developments over the past month have been the startling collapse in the price of oil, though things have since stabilized after the May contract dipped deep into negative territory. We also saw the German court ruling against the ECB, saying some of its QE measures were unconstitutional. However, we don't believe this issue will present any major risk going forward, with plenty of opportunity for the ECB to work around the setback, which has been met with severe opposition outside of Germany. As we take it all in and look ahead, we believe the path forward will continue to translate to outperformance in the major currencies relative to commodity block and emerging market FX. The prospect of a V-shaped recovery post-coronavirus has been increasingly unlikely, and with monetary policy and government stimulus efforts that much more exhausted, we're hard-pressed to see how the market will be able to hold on to the type of optimism that's been seen since stocks bottomed out in March. We worry about the ability for governments and central banks to handle that next future negative shock when it comes rolling in, and we worry the expectation that things will snap back is an expectation that will be let down. With that said, we believe risk-correlated FX will be exposed to deeper setbacks as stocks come back under pressure. At the same time, we are not as convinced the US dollar will outperform as much as we've seen when it comes to the other major currencies. The political pressure from the US administration to push its soft dollar policy agenda is very much alive and well, and we suspect the administration will look to tighten that grip on China and other trading partners, which will make the US dollar less attractive. We expect the yen and Swiss franc will generate a lot of interest despite well-publicized resistance to currency appreciation in Japan and Switzerland, and we expect the euro and even pound to hold up well against this backdrop. The strain on emerging markets throughout the pandemic has also been quite severe, and it's important to highlight the systemic risk associated with further weakness in emerging market FX against the US dollar. Emerging market economies have already been struggling to finance US dollar denominated debt, and the global economy won't be wanting to deal with any blow-up that comes from this side. Of course, the outlook remains quite gloomy in our view, and we do expect more fallout in these risk-correlated currencies as a result. Finally, we expect the conversation around negative interest rate policy will gain more traction, and it will be interesting to see if the Fed can hold out against the will of the market to move in this direction. Jerome Powell has pushed back against negative rate policy to this point, but bending to the will of the market has been a consistent pattern in the Fed's history over the past decade plus, and if it's in fact pressured to move in this direction, it will likely open the door to more moves in this direction at other central banks and push the global economy further into severe debt, carrying dangerous consequences looking out that could start to weigh more heavily on investor sentiment. Overall, we look for safe haven currencies to perform well, with risk for the US dollar to share more of the load as the US administration flexes its soft dollar policy muscles. We look for risk-correlated FX to underperform, and we expect another big downturn in global equities. That's all for now.